Uh, let's begin by having you describe this magic formula that enables you to do so well in the stock market, and you actually wrote a book on it, The Little Book That Beats the Market, and this was several years ago, and you're still alive and you're still beating the market. So can you describe it for us, please?
Sure. It's really basic value investing, based on both Benjamin Graham and Warren Buffett. I started investing back in the early 80s, and we were quite successful for a period of time. And some of the things that I teach over at Columbia and the reasons why I think we were able to make money, I kind of put down in this book. And there were two main principles, one from Graham, one from Buffett. Graham's was figure out what something's worth and pay a lot less for it. So if you can buy it cheap, that's a good thing. The other concept, sort of what Warren Buffett brought to the table, I think, from his teacher Ben Graham was, well, cheap is great, but if I can buy something that's also good, in addition to cheap, so if I can buy a good company at a cheap price, that's even better than just looking at cheap alone. The concept what we look at is EBIT, earnings before interest and taxes, to take out companies with different amounts of debt and tax levels, which is earnings before interest and taxes, and we compare that to enterprise value, which is basically the stock price plus the amount of debt per share that a company has. So we're just sort of leveling the playing field for companies that take on debt and companies that don't. But when you buy a share of stock, what you're really doing is paying for the equity, but you're also assuming the debt that the company took on. So we're taking that into account. But really all we're doing is comparing the earnings of a company to the price that we're paying. And so we use a concept which is return on tangible capital, really also learned from Buffett, which basically says a business to operate needs working capital and it needs fixed assets. And the question is, how well does a company turn that working capital and fixed assets into earnings? So we compare earnings to net working capital plus fixed assets to see what kind of return on tangible capital a company can earn. So the higher, the better. So I told my son, imagine that this kid, Jason, grows up and he opens a gum store and calls it Jason's Gum Store. And each one of those gum stores costs $400,000 to open for inventory, for the displays, and the store itself. It's $400,000. Each year that store earns $200,000. So we look at that as a 50% return on capital. If he can lay out $400,000 once and it spins out $200,000 a year, that's a 50% return on capital for each store that he can open. Then I told my son to imagine another store. They'll call it just broccoli, and all it sells is broccoli. And it still costs, unfortunately, $400,000 to open that store, but each year that store only earns, don't ask me how, $10,000 a year. And that, we said $10,000 divided by 400,000 is a 2.5% return on capital. And when we rank businesses, we say 50% return on capital is better than a 2.5% return on capital. So what we did for what I called the magic formula in the book is we rank all companies based on their return on capital. And we also rank all companies based on how cheaply we can buy them relative to their earnings. The more earnings, the better. Then we combine those rankings, and the companies that have the best combination of that ranking go to the top. So we're not looking for the cheapest company. We're not looking for the highest return on capital company. We're looking for the companies that have the best combination of those two attributes. We look at EBIT as one of our earnings before interest and taxes. If you look at a bank before interest, it kind of doesn't make a lot of sense. Right. So in our analysis, we eliminated certain types of companies, really two types. One were financials. They're different animals, and there's nothing wrong with investing in financials in general, but our metrics don't cover financials. They're kind of viewed in a different way, and this formula does not apply to them. I wrote the book in 2005, not anticipating any financial crisis or anything like that. It was really eliminated because they weren't really appropriate for financials. The other are utilities, because utilities are regulated entities where their returns are regulated. They're not really capitalist companies, and so they don't follow the same rules as what we're looking for. So we also eliminated those in our study. It's just not appropriate, the measures we were using. So I think the most exciting thing we found in our research, though, was not that this just worked for finding the best stocks. We said, well, maybe you get lucky picking the top 30 stocks that meet these criteria. So we actually did an experiment. And we divided the top 2,500 companies into deciles. The best 250, according to our formula, the next 250, according to our formula, the next 250, and we tested this over 18 years.
Line.
And what actually happened was the same thing, meaning the top decile beat the second decile, beat the third decile, all the way down to the 10th decile in order. So we're doing something very powerful here. We're sort of saying which group of stocks will do best next year. That's kind of valuable information if you can put together a group of stocks and say which ones will do the best. And this followed through no matter how large the companies we use. So it's very reproducible, for institutions or for a great many individuals. Obviously, individuals have an advantage because they can buy smaller stocks, but even institutions can take advantage of this. Over the last 10 years, we opened a firm called Formula Investing because I got so many emails from people saying, thanks so much for writing a book, thanks so much for the formula, but can you just do this for me? So we got enough of those, and I teamed up with a gentleman named Blake Darcy, who founded DLJ Direct, and we put together a firm to make it easy for people to do this. And we did a study saying if you followed this principle on the largest 20% of stocks over the last 10 years, what would have happened? So the S&P was actually down over the last 10 years, ending September. If you had followed this strategy, you would have been up about 288%, according to our study, which is almost quadrupling your money during a period where the market was down. More importantly, I wrote the book 5 years ago. So during the last 5 years, this also continued to do very well, meaning the market was only up about 5% during that period, and following the strategy, you would have been up about 72%. So you would have beaten the market by more than 10% a year during that period. And if I had written a formula up that worked every week and every month and every year, it would stop working. Fortunately, this formula is not so great. There's two reasons. One, the formula doesn't always work, even though it works over long periods of time, because when you think about it, what I think you're doing is buying above average companies at below average prices. So you're buying above average companies only when they're available at below average prices. And that makes sense over time, just doesn't work all the time, doesn't work every year. The other thing is if you actually look at the names that you're buying and you read the paper, you wouldn't buy any of them. There might be construction and engineering firms now. Everyone knows the building boom's open. There might be pharmaceutical firms. We know healthcare reform might come and the government might pay a little less. Actually, if you go through the whole list of top-ranked companies, there is a reason, and you know it because you just read the paper, why you wouldn't buy any one of them. You could, and everyone would know the reason why you wouldn't want to buy them. So it's actually very hard to do. So the computer is telling you to buy these things that do get high returns on capital and are available cheap, but everyone thinks maybe the future won't be as bright. Pay much.
The minimum number you figure is 20, 24, 25 stocks?
Yeah, what I suggest in the book was 20 to 30 stocks at a minimum is what you should do, and do this over a long period of time. Right, well, we really haven't had to be that patient even during this bad period. In other words, over the last 5 years, which haven't been good, you would have been up 72% since I wrote the book versus up 5% for the market. There have been some tough periods in between. Without those tough periods, every single person would do this. If I printed a formula and it worked all the time and there were no volatility to it, you'd have Bernie Madoff and everyone would want to do it, but it really wouldn't continue to work over time. There's two reasons why stocks move up and down in rankings. One is their prices change, so you get them cheaper or more expensive. The other is earnings change. So over time, each person every day that comes in will get a different list based on what is the cheapest for the day they come in. And we update the portfolio every quarter so that based on the day you came in, you'll be updated on a different day than someone else so that you're not buying into somebody else's portfolio. There have people who have done studies after I wrote the book. There were a number of Wall Street firms that did studies that showed it worked in every country. They tested about 12 different countries. And these principles, value investing, for instance, buying cheap, buying good, works.